Welcome back, traders and creators. In today's video, we're going to talk about the FU candle method. This is the method and trading strategy that you can implement in order to get the best risk to reward on your trades. So I'm going to explain what this method is by showing you on this chart. What we have here is an odd JPY on the hourly time frame, and I'm just going to break down what the FU candle method is. Now, if in this video you don't understand it, I highly recommend that you go to the other videos that we have on our channel and check those out so that way you can start to understand and implement this method into your trading. So the first thing that you want to start with when looking into an FU candle is you want to understand where retail stop losses are. Now, a good way to understand where retail stop losses might be is you have to look for retail patterns. Remember, there's a reason and a saying that 90 to 95% of retail traders lose in these Forex markets. That's because they all trade the same, so their stop losses are all in the same spots as well. So with that theory backed by this method, let's just look at this. A lot of traders love to trade double bottoms and double tops. And what we have here is a double top. Typically, what happens is if you don't know what a double top is, it's when the market comes up to an area once, twice, maybe even 3 times, and this is a good selling opportunity for a lot of traders. So what they end up doing is they place a lot of sells in this purple box, and typically stop losses are placed right above those highs. That's usually what the method is. Now that we found our retail pattern, our double top, right, this area, now we can understand that stop losses are going to be placed above those highs. Next method that we need to know is we need to see the market sweep past those highs, and this is the FU candle. The market needs to sweep past those highs with either a wick or a full body candle. It doesn't matter which, as long as the market goes above. So let's say this red line is the stop loss, retail stop losses. If we drag this out, we can see that over here in this area, by this yellow eclipse, the market came past these stop losses, took all these retail traders out that were selling in this market. It took all of them out of the market. And so this is why we call it the FU candle, because this candle is being produced by big banks, big buyers, an institutional candle, and it's saying FU to all the retail traders, taking them out by hitting their stop losses. And then what happens is the market reverses in the direction of where the retail traders thought it was going to go, but they're no longer in the trade anymore. Then third step, what needs to happen is there needs to be mitigation. Basically, when big banks, hedge funds, big traders get into buy positions or sell positions to take out retail traders, they also sell on the other side to make money. But in order to make the most profit on that down move in this instance is first they need to get out of their buys. So typically what happens is after they've taken out all the sellers in this scenario, the market comes down, but then they have to come back up to get themselves out of these buys. So typically your good entry spots can be in these areas where the FU candle is, and then you just take your area from the wick or the body of the candle or wherever, but this is typically going to be your entry zone, and then your stop loss is going to be above this high. And the reason that that's not really contradictory is because all the retail stop losses were already hit here, so big banks have no reason to come past this high. So your stop loss would be right here, and your entry zone would be at the candle or the wick of where it took out all the retail stop losses. And now if you were to play this out, you can see that your entry zone would be right around here. Let me make this smaller. Your entry zone would be somewhere right around here. Stop loss would be nothing more than, let's say, 25 pips. But then your targets can be where other stop losses might be, right? You may have stop losses over in this area because these are lows, or even continue coming down to these lows. And now you can see that your risk to reward is almost a 6 to 1 even if you brought it back up here, risk to reward's 4 to 1. So in order for you to be a trader that's not profitable, you have to lose 4 or 5 times in a row before winning. And so that is the FU method, and that is what creates such successful traders, because the risk to reward is at such a great advantage to you that even if you do get these trades right half of the time, you are still a profitable trader with proper risk management. So if you guys enjoyed this video, make sure you do go ahead and follow the YouTube channel so you can see more videos like this, and follow us on Instagram so that way you can get more daily Forex content. I'll see you guys in the next video.